Hello everyone, how are you doing? I'm doing good as well. Just trying to be very positive. In fact, I'm quite positive about life, and I'll make sure that from my side, at least, all of you will get positive energies. Because this is tough time, and we all have to together get out of this tough time. Right, so as I promised in my last video that I will try to record one video a day and try to answer major questions which my followers, my friends have been asking me and decode each and every question and create a learning module around that question. Now, today's question is how to do a quick research in any stock. Now, it's a very, very heavy question. Looks very simple, very heavy, but very interesting question. In fact, I'm going to take the liberty to have this video have 40-45 minutes of very detailed discussion on this particular topic because this is very, very interesting topic and very relevant topic for all of us. Now, when we talk about doing research in any stock, obviously there are different objectives by each person. Someone is trying to do research for investing purpose, someone is trying to do research for trading purpose. Well, what I thought that I've been recording certain trading videos because I run a trading desk, so it's easier for me to talk about trading. But I've been an investor also for a couple of years now, and have been blessed with some really, really good stocks. And the overall experience of investing has been decently well. Although in trading, you make money literally every day or at least every week, but investing is something which you create wealth over a period of time, and it needs a very different kind of a mindset for someone to do that kind of a investing. Trading plus investing, doing both together needs a different kind of a balance in one's aptitude, and I'm still trying to figure out how to do that balance and becoming a better market participant doing both trading as well as investing. Now let me use this presentation for the help of going ahead discuss this topic. So when we talk about doing research on any stock, predominantly there are three form of research which I've been advocating. This is one slide which you will find in all my major presentations because I want to make these communications very clear to everyone who is related to market, who wants to come into the market. So I won't mind repeating this. Some people may find it to be repetitive, but please don't mind because I want to repeat this. So there are two forms of research we all already know: fundamental research and technical research. But there's a third form of research which has really come up strong in last 4 to 5 years, is the sentiment research. Now let me take one thing at a time. Fundamental research. What is fundamental research? Everyone knows about it. But my definition is when you're doing fundamental research or you're making a view on any stock fundamentally, you assume that the current market price of that underlying is wrong, right? Either the fair value of that underlying is higher than the current market price, or the fair value of the underlying is lower than the current market price, right? If it is higher than the current market price, the stock is underpriced, and if it is lower, that means the price is overpriced, isn't it? Now, I use the term fair value. You must have realized it. And fair value would mean something, right? Someone has to make an effort to figure out what the fair value is. Because that's $1 billion question. Everyone wants to know what's the fair value of gold? What's the fair value of currency? What's the fair value of any stock? What's the fair value of Nifty? Anything. What's the fair value of me? What's the fair value of this laptop? That's the principal question everyone has when you are doing any kind of commerce with any other person. That what's the fair value? So we have studied in economics in our elementary school days. The price is an equilibrium point between demand and supply. And any price point matching the demand and supply is supposed to be the fair value. All right, that's the typical economic theory. But the accounting logic is very different. And I'm a chartered accountant, so I can actually give you that accounting logic very well. So if you ask me, how do you calculate a fair value of any underlying? For me, fair value is the combination of intrinsic value and speculative value. Okay. Intrinsic value is something which is part of that underlying. You can't decode it. You can't unrelate it. It's part of the underlying. Typically, for a physical instrument, it's like the cost of producing that instrument. That's like the bare minimum price which any manufacturer would like to take to recover the basic minimum cost of manufacturing. Or you talk about the financial assets, then corresponding value which is there as part of that asset. Say, for example, a stock called Reliance Industries. Now, if I have to ask you what is the intrinsic value of Reliance, what's the base value of Reliance? Yes, some of you would have answered it's a book value. That's the base value of Reliance because any company, base value is the difference between asset and liabilities, right? Asset minus liability leads to the base value, correct? That's the intrinsic value. But Reliance currently is quoted at 1070 and the book value of Reliance is 650, right? Which is, say, for the argument's sake, that's the intrinsic value. Why is the difference? The difference for me is the speculative value. All right. Speculative value is that people are speculating something. That's why current price is higher than the book value. And what's the speculation? People are speculative that the earning growth will be like this. The company will grow in certain way. These are the speculation with respect to future. So a combination of the past, which is the intrinsic value, and the expectation of the future, which is the speculative value, actually makes the value of an underlying, right? Now let me take you go through a simpler example. Let's take an example of this laptop, which I'm using to record this video. It's a Dell laptop. The cost of this laptop to me was 60,000 rupees. So I paid Dell 60,000 rupees when I purchased this laptop. When I have to arrive at the intrinsic value, I will see what is the cost of producing this laptop, like cost of the components plus the labor cost plus the manufacturing cost, etc., assembling cost. So say the intrinsic value of laptop comes to around 40,000 rupees. Plus there is a margin which is earned by the manufacturer as well as by the distributor. So say that margin is around 10,000 rupees more. So the overall fair value of this laptop is 50,000 rupees, but I've still paid 60,000. That means I agreed to pay 10,000 more for this laptop. Why? Because it is Dell laptop. Because the brand gives me that kind of a comfort that I'm willing to pay a premium for a brand, Dell. And we all know what's there in Apple, right? Ultimately, it's a brand which is attracting people to buy at a premium price as well. Now, say for example, I tell you that this laptop was actually owned by Mr. Sachin Tendulkar. He used this laptop for around 3 months and then he gave it back to the vendor and took a higher configuration laptop. But the vendor now has put this laptop on sale, saying that for 3 months, Mr. Tendulkar's finger has touched this laptop. Now, what's the price of this laptop? Now, what's the fair price? So let me open an auction for you guys. Why don't you auction? Why don't you tell me what price you're willing to pay for this laptop? Oh, yeah, I can hear some people saying 2 lakh, 2.5, 3. Wow, 5 lakhs. Wow, interesting. See, so the same thing, which was fair value 50,000 when I thought it to be like that, suddenly a situation changed and the fair value actually went up to 50,000. Why? The intrinsic value still remains 40,000. But because there is a speculative angle which came into the picture, why? Because there is a limited supply of this laptop, because Sachin Tendulkar has just touched one laptop. There's a limited supply and there is too much demand now because everyone wants to own a laptop which is kind of touched by Sachin Tendulkar, right? So the speculative value has led to an increase in the overall fair price of the laptop, right? So for a fundamental analyst, it is important, it's very, very important to evaluate what would be the right fair price. And it's very, very difficult task because to arrive at the fair price, you need to see the factors of demand, you need to see the factors of supply, and you need to make a fair estimate of all those factors, which finally would lead to the fair price of your particular underlying, right? Now let's go to technical analysis. What does technical analysis do? Technical analysis believes that the current market price is the right price. It's a perfect price. They don't want to argue with the market. They say that boss price you are God, whatever you are saying is perfect. We don't want to argue with you. Whatever is the current market price, that's the perfect price. All a technical analyst does is follow the crowd, follow where the price is going, and try to predict probably the price will go in this direction. Probably the price will go in that direction. So a technical analyst is actually someone who is just following the crowd. He's not trying to be unique. He's not trying to be contrarian. He's not trying to be iconoclast. He's just trying to follow the crowd and make money where the crowd goes. The third form, as I was talking to you about, is the speculative side. It's more on the sentiment analysis side of the market, where you try to figure out what is the intrinsic sentiment associated with that underlying among the market participants. Now, this how do you measure the sentiment? Sentiment is measured by the kind of feeling people have, the kind of interactions people are doing, the kind of intent people have for that particular underlying, right? For example, one of my theory which I one of the concept which I tell people is that every stock has an operator, and the operator will take that stock to certain level, and you as a smaller participant, including me, should always try to figure out what is the operator trying to do. So your activity is linked to the sentiment of the operator, right? And there are signs through which you can actually try to figure out what price probably the operator is there, and you would like to follow the operator accordingly. Or the other way around could be also the sentiment associated with that stock among public in large. So say when I talk about Reliance to you, and it's not a secret anymore that my favorite script has been Reliance for a couple of years now. So if I say that the fair value of Reliance is 1800 rupees, just for the argument's sake, and currently the price is 1070, 1080. Now, for me to justify would need a lot of data points. Yes, I will use those and I will try to convince you. And say most of you who are watching this video finally gets convinced. That means a positive sentiment gets generated inside you for Reliance, right? And if you use that positive sentiment and next day go to the market and trade Reliance or buy Reliance, now see the same sentiment is now getting converted into price action, which is technical. So sentiment is actually one step before technical analysis. And last 4-5 years, lot of studies, lot of new way of looking at data has evolved, which is making the analysis of market through sentiment perspective very, very robust and very effective. The implementation of AI, big data, robotics, these are helping deep data miners to figure out what kind of sentiment is associated with any stock. Okay, so I just laid the background of research and what kind of research typically are people doing to evaluate a stock. But for today's video, we are not going to talk about all three. We are actually going to restrict ourselves to only one specific kind of a research, which is more fundamental in nature. Okay, so the scope of today's discussion is investment research. That someone who wants to take a sensible investment position in a stock, right? I've recorded many videos on the trading side. I mean, you can see my Market Shala series with Chetan, where I have a lot of videos on trading. Then we have videos on as a face-to-face series. You see, I've recorded a lot of traders also. But if you see from the investment side, I see this is the time when you can actually start building your knowledge bank, because once markets turn, and it will turn, it's not a surprise, markets always will turn, then there will be enough opportunity for you to wealth create from the market. Okay. Now, what are the components of investing research? If I have to answer this question, there are largely two kinds of information available to you. One is the hard information, another one is the soft information. Okay. The hard information is typically the financials of the company, the sector performances, and other market data, for example, delivery data, open interest data, another form of data which is widely available, right? You all need to do is make sure that the quality of data is good and the whole experience of consuming the data is also very good. And that's what we did in Stockage. Stockage app is actually a perfect platform for hard information with respect to any stock. You have everything inside the app or the web now, which you can use to figure out the hard data with respect to any stock. But the most critical thing for me in evaluating a stock for investment purpose is the soft information. For me, if you ask any sensible investor, Rakesh Jhunjhunwala or Mr. Ramesh Damani, who is my mentor, if you ask him that what's the most important thing for you to look at when you're investing in a stock, first thing he will say the promoter conduct. How has been the promoter, whether the promoter is trustworthy, whether the promoter has done any Gucci in the past. Then what kind of team is there with the promoter, and whether there are old guards or they are the new modern age dynamic guys, and then what kind of expectation people have from the business, right? So if I'm an equity investor, I will rely more on my softer skills to evaluate a company than on my hard skills. There are a lot of platforms these days who are providing you driven ratings of stocks. They all take into consideration the hard information, which is doing plus minus multiplications from various data points, which is already there in the market. Well, in stockage also, we can do that very easily. Probably in a week's time, we can give you that rating based on hard information. But I don't think so. Equity works with only hard information. The most critical component of evaluating a stock is actually the soft information. And soft information will only come if you spend considerable amount of time in evaluating a company, right? My theory is that you need at least 300 hours of quality research in a company before you can start making a sensible call on that company, right? Especially when you're looking at fundamentals. Technicals is easy. You just need to see a chart of a company for 4 5 hours and you're pretty much sorted. Then you need to know the exact levels of breakouts. But from a fundamental perspective, I strongly believe you need at least 300 hours of quality study on that company, because it's not just about the company. It's about the sector of that company. It's about the peer group of that company. Everything would be needed to be studied before you can make a sensible call on that company. Well, through this video, I'm trying to give you a framework which will help you to do a quick research on any company. And that quick research can be done in no time, in as less as 3 hours. But then quick research will only help you to filter whether you want to take that company for the next level of your research. Because finally, your next level of research, before you actually put your hard earned money into the market, should be as exhaustive as 300 hours of quality research in that company. Okay. Now, let's digress a bit. I thought that if I am making a video, I should actually give you a cross-sectional understanding of various things. Let's digress a bit. We'll come back to our discussion later. But let me talk about this important point. Is buy and hold strategy dead now? What do you think? What do you think? What's your opinion? Think about it. Buy and hold strategy, the strategy which has been played in the market by Mr. Warren Buffett, Charlie Munger, and these people have done incredible well. And there are some people who are still making a lot of money from that strategy. But do you think buy and hold strategy will work from the coming 10 years perspective in the world? Well, see, I'm a very small guy, very, very limited knowledge and very limited wisdom and experience in market. I'm just trying to build. I mean, 15 years is too short a time for someone to build a phenomenal wisdom with respect to market. But with my limited understanding, I can say that the world is no more the same after 2008. Before 2008, world was very different place. After 2008, world has become very different place. Can you tell me the reason why? Why I'm using 2008? Think about it. Any guesses? Think about it. Now, 2008, obviously, there was a crisis because of which there was a major liquidity outflow from the system. But then that got recouped after a lot of quantitative easing came into the picture and government started printing a lot of money. But the real difference happened at a macro level. I think the last such changes happened when internet was introduced. And 2008, a macro change happened in mankind was the introduction of Google Android Play operating system and opening up of Play Store by Apple. Now these were so important changes that the whole mechanism of doing business, of delivering experiences to the client, everything got shifted to mobile India, right? The mobile phone has become such an important part of our life that even Stockage, we actually started with mobile phone strategy, but now we have launched web also because we have realized that so for serious evaluator, serious analyst, you need a web version. So we've launched that also. But nonetheless, mobile has changed the way we all do business, right? Take a case of local transport companies like Ola, Uber. Why they have grown? Because Google opened up their Google Map. Imagine if there was no Google Map, and imagine if there was no operating system like Android, we would not have experienced Ola and Uber, right? We would have had to have the experience of same taxis, which we have been experiences over centuries, right? So 2008 was a landmark year when the whole world changed. And with this change, a lot of things changed. The whole monopoly of doing business shifted from a buyer, from a seller to a buyer. So to in a very simple language, before 2008, seller was the main guy, right? If I increase the capacity in my factory, I will sell more, right? But now no more. Now buyer is an important person. With Amazon.com in picture, with Flipkarts of the world, why they are so finicky about knowing the buyer behavior? Because finally you would only like to give your product or services which is more relevant for that buyer. So that's why if you start searching for anything in any of the websites on internet, they try to evaluate who you are and then accordingly push the right product to you. So the whole business model has shifted from seller's monopoly to the buyer's monopoly. All right. Now, third reason why things have changed is no one wants to own any asset anymore, at least globally. In India, obviously, we have this special affinity towards to real estate, but typically, the modern world doesn't want to own an asset. No one wants to own a car. No one wants to own a building. So, if people don't own multiple things, and if there is shared economy everywhere, then obviously GDP growth will be restricted. So the global GDP will not grow phenomenally because the shared economy will become such and such a big thing that people will not be interested to buying everything. People will be willing to share things with others. So the multiplication impact of everyone owning everything will get reduced. Thereafter, GDP will definitely get reduced. And the fourth point is that the technology change has become so dynamic that it would be difficult for a company to project their future revenue potentials. For example, today, automobile companies don't know about their future, right? Because what kind of development is coming in automobile sector is not going to be the same which is there right now. Things are changing. The autonomous cars are coming, the shared economy is growing. So, and that's the reason why auto sector is doing so bad. But one thing is for sure that when there is a threat in certain industries, there are certain industries who will definitely grow, especially the industries who owns the pipe directly to the customer. And those industries could be your telecom companies who are owning the pipe of data, or it could be your household services company who are owning their direct service to the customers. So think about it. That whole business, the way we do business, the way we consume businesses is changing. And this change is going to be there more dynamic now. So things were changing in probably a decade till earlier. Now you'll see every 3 years, every 4 year, things will change because the whole business cycles are changing very rapidly. So for me, I'm not a great promoter of buy and hold anymore. I want to be an active investor. I want to be actively involved in exiting companies. So entering and exiting companies makes more sense because you always need to see what could be the price where I would like to exit my stock. So if I have to kind of define that what should be your path as an investor to look at the market, especially when you are not thinking about getting into investing in stock market or investing in stocks directly, first thing is that you become an active investor. All I'm asking you is that give 2 hours a week at least, only 2 hours a week, and make sure that you look at your portfolio in a more active mindset, not just a passive mindset where you keep on doing SIP and you keep on investing in stock based on other people's opinion. No, don't do that. Obviously, we have to do that as well, but at least give 2 hour to 4 hour time every week in your portfolio and try to realign your portfolio if there is any material change with respect to your investments in the company. And when I'm saying investments in the company, it also includes investments in mutual fund, because anyways 45% of your mutual fund invested investments are invested in equity markets, right? Second, the initial research which you do for the company, and you have to do it. No one can come and give you the best stock idea. Only it's you can listen to other people, but finally it's you who have to press the trigger. People can give you gun. To do that, both objective and subjective parameters have to be correctly evaluated. Third point is, please restrict yourself to companies whose business you understand. Like, for example, pharma drug manufacturers, I can't understand their business. That's not my forte. And so that's why I don't look at them. But yeah, I look at other industries where I know I can understand them, I can understand their product, and I can figure out what's wrong with them. So only invest in those companies. And the fifth point is, as I said, there should be always entry and exit, and look at broader technical parameters, broader price movements. Maybe look at weekly chart over a period of 5 years to 7 years, and try to figure out broader entry and exit levels of the stock and play the market or your stock according to those broader levels in the market. Okay. Now let's go back to the point was, how do you identify which stock and how do you evaluate a stock? So I would give you these five broader parameters one has to look at to evaluate a stock. One, growth, whether the company is growing in terms of revenue, in terms of profitability, in terms of scale of operation. Second, efficiency, whether the growth is compromise in efficiency. No, whether the growth is complemented by efficiency, right? So efficiency could be efficiency to collect the money, efficiency to use the fixed asset, efficiency to use the manpower in a better manner, right? Then third is profitability, कि whether kamai is happening or not, paisa ban raha hai, whether the company is making profit, and if it is making profit, whether the profit is getting converted into cash or not. I hope the company doesn't make money and keep it in debtors. Eventually, you don't realize the cash out of the business. Third, fourth, solvency. Whether the company is in a position to remain solvent for a long period of time. So, what's the debt? Whether they are making enough operating cash flow to serve the debt, whether their current assets divided by current liability, which is their liquidity ratio, they are in a comfortable position there that they don't run out of capital in a short term working capital. Fifth is the price, that all stocks are not good buy at all price point, right? So whether this is the right price to buy or not, and there are tools which can decide for you whether it's a right price or a wrong price. And the sixth is the quality, which according to me is the most important thing. Whether the quality of the management involved, the team involved in evaluating a company or in running the company is good enough for you to put your hard earned money into this company. All right. So let us take a case study, a very, very quick case study where I will explain you through a brief report which we make for our Stockage Club members, where we have actually given a matrix, a properly designed flow, and you can actually adopt this flow and use it for your working also, where we have defined all the matrices and taking input from Stockage itself and try to grade each and every matrices. And I strongly believe that grading should be as subjective, because you may have your own evaluation matrix, I may have my own evaluation matrix. I'm giving you a framework. Then it's up to you what kind of numbers or grading you want to put in those evaluation matrix. Now let's go to this case study which we have. Okay. So this is a case study. These are the kind of case studies we make in our club, Stockage Club, for our club members, where we make a brief report on all the stocks and rate them on the basis of each broader category of stock analysis. First section is about the company. This is very simple. Where do you get the information about the company? You know, the best thing to best is go to stockage application. You can go to web.stockage.com, or you can actually go to Stockage app also later. But go to Stockage tool And in Stockage tool, when you search for any company, so say I search for this company, Dr. Lal Path Labs, okay? When you search for any company here, sorry, yeah, okay, got it. You get all the information related to this company inside Stockage app, right? When you go to fundamental, you get something called show profile. In this, you get a brief profile of that company. What is this company all about? What business are they into? A very quick, brief profile about the company and the kind of awards this company has received, the kind of recognition this company has received. Apart from this, you also get the website address of this company right from here. So you click here and you straight away go into the website of that company, right? And trust me, my dear friends, the website of the company speaks thousand words than any other thing. If you look at the website of the company, you will automatically make a judgment that is this company pro investor, pro consumer, pro management, pro business. Look at this. The overall feel of the website is very positive and they believe in servicing customers. The whole image, the whole look and feel is more servicing the customer and selling the right product to the customer. Okay. Any company, sensible company in the website will have about us. So you go to about us, you will get a very good description about the company. So the basic knowledge you get from here with show profile, but you want some advanced understanding about the company, go to their website. Don't go to any other portal, go to their website and read everything about it because they will write everything true about themselves. So you'll have to go to their website first, like our story, team, what are the celebrity accreditations they have, etc. etc. Right? Also, apart from about us, most of these listed companies will have one more section called the investor section. And in investor section, you will get all the data or the documents which is relevant for an investor to look at the company. Good point is that in Stockage app also, all these informations we have already inculcated. So if you see, there are the two very good information which you will have to kind of read from every company. It's the earning presentation and con call transcripts. You see in Stockage, in Outlook, we have given you the con call and the earning presentations of the company. So you just have to click here and you directly open the PDF and you get the exhaustive PDF from the company which is submitted to the exchanges. Okay. So most of this research, the initial part about the company, etc., is actually taken from the company website, and which obviously you will have to study company website because that is your first point of information about the company from the company itself. And the data like revenue mix, etc., can be actually taken from that investor presentation which the company has to give on a quarterly basis, right? Then you remember the six components. We start evaluating all those six components, right? And all the six components, we have very smartly in Stockage also clearly classified all the six components. So if you go to fundamentals and if you go to ratio, you will see all ratios are classified in the basis of these six components. So we have made your life so easy that you can actually take one component at a time and then give a grading to that company depending upon your assessment of the company. It's very easy for us to give that assessment, but trust me, my dear friend, depending upon your risk profile, you can actually grade the company much better than what we can do. We will definitely be doing, we already are doing for Stockage Club members, but we'll love to see you as an independent investor in the market start making this kind of a analysis for each stock based on the framework which we are giving to you. Now in this PDF, you see in stock, we have given a screenshot of Stockage app. If you see, there are last 4 to 5 period data in this screenshot. But good point is that now Stockage has 9 period data. So you can go to the app to see the 9 period data also. And you click on the graph, you can see the 9 period trend in the graph also. And in app version also, which will be the Stockage version 5, you will get a 9 period data very soon. So you don't have to limit yourself to 4 period, 5 period. You will be able to get 9 period analysis, which I think is more than sufficient for you to analyze any stock. Now, suppose you are a fresher, you are someone who doesn't have too much understanding of these concepts. What we have done is in Stockage is something called I. If you click I, you will get on the right panel of the web or on the top side of the app, you will get a short video explaining the concept and a quick text explaining the same concept in a textual format. And for people who can't understand English, people who want to see these in Hindi, so we have Stockage as a Hindi version also. The moment you go to Hindi and you search for the same stock, all the description which you find here will also get converted into the local language, right? So let me go back to English because that's easier to kind of explain when we are doing a webinar. Okay, so this is it. Let me just go back to the company. Yeah, okay. So all the framework is well explained. So I'm taking each and every ratio and trying to use that ratio performance of the company and grade the company based on each and every parameter. For example, growth. I'm looking at sales growth, EBITDA growth, PAT growth, and finally grading the company based on 1 to 5 with respect to growth. All right. With respect to growth, I'm grading the company between 1 to 5. Okay. Then efficiency. Efficiency is how efficiently they are managing their cash, how efficiently they are managing their asset. So cash from operation, working capital cycle, free cash flow, asset turnover ratio. What is the grade you want to give? We may have given grade 4, you may give grade 3.5 or 4.5 depending upon your judgment of the parameters which you have evaluated. Then profitability, EBITDA margin, PAT margin, ROCE, ROE. I will share this PDF with you guys as an example. Just below the video, you'll be able to download. I'll give you a download link so that you can understand this whole structure of analysis and you can use this structure of analysis for your analysis purpose as well. Then you have solvency, debt to equity ratio, interest coverage ratio, current ratio. Then I can grade it based on my understanding. Then you have valuation, how expensive the stock is, whether it's worth buying that stock right now or not. So for that you have PE ratio, dividend yield, and also a long-term technical view of a stock. And friends, making a long-term view of a stock is not at all complicated. All you need to do a basic understanding of tech analysis, which is available in our website itself. Don't have to go anywhere. Just download the app elonmarkets.org, and there is already a free course on tech analysis and other things. You can and YouTube video of Elon Markets has enough a component of learning technical analysis. So just learn basic technicals and follow the long-term trend of a stock by drawing long-term charts like the weekly charts and looking at 7-year, 8-year charts of that company. This will give you an idea about the price, where the price is and whether the price is good price to buy. If it is a good price to buy, then you will give a higher weightage. If it is a poor price to buy, it's over expensive, then you will give a lower weightage. And then you have a quality. Quality, first of all, who are the shareholders of the company? What kind of pattern the shareholding is there? For example, if you see the Dr. Path Lab, the shareholding, the promoter shareholding is pretty much static because the guy believes in his company. That's a very good advantage, right? The FII shareholding is slightly going up. The DII shareholding is pretty much steady going up, and the retail shareholding is going down. That's good because retail are the weakest people in the market, right? If they are reducing their stock, that means the weak people are going out of the market and the strong people are buying the stake of the weak company from the market. This is actually good for the company. Let's take an example of the other company. So let's see Yes Bank. See the shareholding pattern of Yes Bank. This is atrocious. The weaker guys are increasing stake in the company, and the stronger guys, promoter is anyways exiting the company, and the stronger guys are continuously reducing stake in the company. You don't want to get stuck in these companies, right? This for a framework will help you to understand from a shareholding pattern wise the quality of this company is good. Then you have to do a bit of research on the sector, because ultimately if you are taking a view on any stock, the sector also has to perform, then only that stock will perform. So based on your common sense understanding, a little bit of Google which you can do, you will be able to kind of make an estimate of what kind of sector potential this sector has, and whether there is enough potential in the market for this sector to grow. In fact, the quarterly balance sheet, or the investor presentation of the companies which I showed to you, you will get here as well. This also contains fair bit of numbers on the sector side, that which sector is supposed to, whether the sector is good or bad. Oh, we just saw, yes, fine. Let's go back to a better stock. Yeah. Okay, so let's go to Outlook. Yeah. Apart from that, the conference calls which the companies do with the big analyst, it's very good to read this, what they are saying, because generally they can't fool the analysts. And analysts are generally very smart guys who will ask relevant questions. So you'll have to read between the lines and see whether the management is replying to the analyst in the right way or not. And if you see any disconnect between the business and what the management is replying, probably you have to become slightly cautious. How do you become cautious? You reduce the rating here. You reduce the rating of the quality which you have given for this company, right? Like we have given rating of 4. So quality is just to shareholding pattern. Management, who is this? What is the future management is talking about? That is all available in your presentation, investor presentation, which most of the companies give on a quarterly basis, right? And also you can do a fair bit of research on the comparable of a company with the peer group, price pattern wise as well as fundamental comparable. And you can see this in Stockage again. You go to fundamentals and you see there's something called compare with industry peer, compare with sector peer. You click to industry peer and you will see all the players in this industry right in front of you, leading from the top player. And then you can kind of see the performance of each player with respect to that specific fundamental parameter, and see whether this company from a fundamental perspective is comparable to the leader which has highest market cap or not. And if it is comparable, then you will probably like to invest in that company, because as far as investing is concerned, it's always between this or that, which is like a comparable analysis between the peer group if someone has to invest in that sector. Okay, you can do a price comparison also. Unfortunately, we don't have it in Stockage yet, but there are various tools like TradingView, etc., which can be used to do a price comparison between two companies and see whether price-wise the company is outperforming the other company or not. So you make a judgment on the quality. So finally, you land up in a matrix which has a combination of growth, efficiency, profitability, solvency, price, and quality. And this, what we have done is we have given equal weightage to everything. You can actually change the weightage depending upon your style of evaluating the stocks. And after judging these 6 and finally coming out with a magical number, then you can take a call whether this is the stock where I would like to put my hard-earned money. So ideally, what would you like to do is look at add this stock in your watch list in Stockage, track it for a few times. So when you go to my Stockage, you can create your own watch list. All you need to do is just sign in using your login ID, Gmail ID, or a Facebook ID or whatever. Once you sign in, you can actually create multiple watch lists, right? So you can create, say you can add it in your primary watch list and track this stock and see is there any activity happening in this stock. And if there is any activity which is happening in this stock, probably that's the time where you would like to invest or put money in this stock. You can actually give alerts also. I forgot to mention this to you, that right from this app also you can give them alerts. So you can have this my targets where you can define the target, that if suppose the stock crosses say for example 1400, you inform me because say Ravi said. I can also write why I've asked you to do this. Okay, so whenever the stock will cross 1400, you can actually get an alert from Stockage. Okay, apart from that, just a small thing before we conclude this video. Apart from that, you can write your own notes using Stockage. So whenever you are doing any research on in the stock, and if you want to write a note, don't use a diary. You have right here stock notes, where you can take any notes which will act as a reference point for you in future. So whenever you are coming back to the stock for any reference, you know that on this particular date you did that homework and you wrote a note, and based on that note you probably acted. So that gives you a good memory for your purpose of follow on action in that stock. All right. So if you see, more or less, we have been able to kind of give you a formula, a framework to analyze a stock. And if you can follow this framework religiously, I'm sure that you will be able to start evaluating each stock on your own understanding, based on your own understanding, and start becoming kind of an individual, uh, independent person in making a judgment on each stock. As I said, friend, that it's not easy to make a judgment on a stock, very honestly. You need a very, very thorough analysis and more deep dive analysis. But this quick research framework will make you enough ready or empower you enough to think about going to the next level in the stock. So if suppose you get many stock ideas from people, take those ideas, evaluate those ideas based on the framework, and maybe out of 10 idea, one idea you will find interesting, and you may like to go to the next level of deep dive research, which will take almost 300 hours of research if you want to put some serious money into the market for that particular stock. All right. So friends, we as part of Stockage, we have been developing a lot of these uh, frameworks, a lot of these products, which will make an independent, a particular person independent in what the person is doing. All right, and Stockage Club is one of the platform which is helping our club members. We have almost more than 700 plus club members now. It's a freemium service where we just don't do this. There are paid webinars which we give you free of cost, and Stockage subscription is also there. So in this Stockage Club, we keep on making these kind of reports based on request of our club members, and then we keep on adding more such research so that our club members are much more updated and much prepared to face the market in the true spirit as an investor or as a trader. So I would seriously advise you, if you can join Stockage Club, you will not be disappointed. It's total value for money offering which we have from the Stockage family. Thank you so much for watching this video. I hope I've been able to clarify this question. Looking forward to answer more questions. You keep on sending your questions, and I will try to create one video per day to answer all your relevant questions. Thank you so much, everyone.